Greetings viewers. I welcome you to the series on security analysis and investment management. I am Dr. Isha Raval, Associate Professor and IQAC Coordinator at Vivekananda Institute of Professional Studies, Technical Campus, Delhi. Today in this session, we will be discussing about what exactly is risk when it comes to investment opportunities. Risk, as the name suggests, is the possibility or probability of an investment resulting in an outcome which is different from the anticipated outcome. There are a few words, very technical words, which I have used just now. The probability of an investment resulting in an outcome different from the anticipated outcome, different from what you expected. So, if you want to understand risk, we can say that when you are putting your funds in a specific investment alternative, there is always an expectation. So you expect a certain amount of return, a certain quantum of return. And when your end result is different from what you anticipated, it is different from what you expected the return, the kind of return you expected, then in that case we say that difference, that volatility, that differentiation in the return is actually your risk. So we can say that risk is actually the volatility of returns. That means there is an expectation of a particular quantum of return, a particular percentage of return, but when you don't get that percentage, when you do not get your desired outcome, when there is a lot of difference in the desired outcome and the actual outcome, that difference is actually the risk associated with a particular investment opportunity. Now, risk is, we always say the more the risk, the higher the return. That means, be it any investment opportunity, there is always a certain amount of risk associated with that particular investment opportunity. Again, it depends on the risk appetite of an individual, what sort of investment opportunities he or she selects, looks for, identifies, and then finally puts his or her money into it. Now, when an investor decides that he or she wants to stay invested in the securities market, in the stock market, there are multiple kinds of risk associated with all these securities. So today we will be understanding the different types of risk associated with stock market investments. Let us understand the first type of risk, which is business risk. Now, business risk is the risk which is associated with running a business. The risk can be higher or it can be lower depending upon the time. So there would be times when the risk is pretty high, there will be times when the risk is very, very low. But all of this will be there as long as the business is being run, or the expansion is happening, or there are operations which are taking place in a particular business. Now, you as an investor, when you invest your funds in a particular stock or in a particular company, it is not actually just one stock which you are investing. You are actually parking your funds in the business of that particular company. Because when you're buying a stock, when you're buying a share, it is not just an investment. You are actually becoming the owner of that company, because every stock, every share has the ownership right attached to it. So when you are investing your funds in any, say, Tata Steel, so you are actually investing your funds in steel industry because you think as an investor that steel industry is pretty lucrative. You are likely to get returns. So when you put your funds in power sector, or when you put your funds in, say, Tata Power, or when you put your funds in Reliance Industries or Reliance Power, so you have an inclination towards the power sector, you understand the dynamics of that particular industry, and that is why you chose as an investor to put your funds in the power sector. Now, all these sectors, all these businesses are prone to multiple types of risks. And when they are exposed to these risks, the performance of the business goes down, their returns go down, there can be an increase in competition, because if there is a business which is very, very lucrative, which is generating good returns, obviously it will attract a lot of competition. And with the competitors entering the industry, as a businessman, you are likely to your profitability will shrink, and when the profitability of a business shrinks, ultimately it has an impact on its share prices as well. So that is another reason which can be contributed as business risk. There is a possibility that suppose you are the owner of Infosys. Let's take a hypothetical example. So you're running the business of an IT sector. There is an emergence of new technology, and you do not have the bandwidth of shifting to the new technology, or your employees are not able to cope up to the new technology. Of course, the performance, you'll become a laggard, and the performance will not be up to the mark, and the stock price is likely to doom. That is why, and that is another risk factor which is associated with business risk. Now, there can be development of a substitute product. Now, these days we've been seeing that laptops and smartphones. So, a smartphone is actually being used to do all the working of a laptop. Now, the companies which have been manufacturing laptops, they have been shifting to produce smartphones. Why? Because smartphone is gradually coming up as a substitute product for laptop, because 90% of the work can be done in the tab or can be done in the mobile phone itself. You can check your emails. So, there is an emergence of substitute good. And when there is an emergence of or development of substitute products in the market, you get a direct competition. The level of competition increases and the profitability goes down. Then there can be another reason of business risk is that the consumers, they shift their preferences. So if you're into the fashion industry, you put your funds in a company which is into fashion industry, which changes very frequently. So consumers' tastes, consumer preferences, consumer likings, they change very frequently. So you have to be really updated, and you will have to replenish the stocks on regular basis in demand, as per the demand of the consumers. And if you fail to do so as a businessman, again the performance will not be up to the mark, and the returns will not be that great. The profitability goes down, and ultimately when the profitability goes down, that has an impact on the share price of the company. There can be reasons. There are certain industries which are very much dependent on government policy. Say, for example, we talk about the cement prices. So, if you invest in the cement sector in a particular company which is manufacturing cement, and there is a price cap by the government stating that the price of the cement cannot go beyond a particular level, as determined, there is a price ceiling. When this price ceiling is announced, the manufacturer actually cannot intervene, cannot go beyond the price which is decided by the government. So there are many sectors which are determined and which are governed by the government policies. So if you happen to invest in that industry, so if you put your funds in petrochemicals or in petroleum industry, again there is a lot of fluctuation. So all these factors, maybe business performance, or your increase in competition, or maybe emergence of new technology or substitutes goods coming into the market, or the shift in the consumer preferences or changes in the government policies, all of these actually contribute to business risk. And when the quantum of business risk goes up, anything here and there ultimately has an impact on the profitability of the business. And because you as an investor have invested your funds in that particular organization, your return is directly related to the return or the profitability of that particular organization. So that if the profitability of the company goes down, ultimately that has an impact on your overall return. So when you are understanding, when you're doing the analysis and identifying the stocks to stay invested, it is very, very important to understand the business, whether it is governed by the government, whether there are strict guidelines as to the MRP which can be charged, what is the kind of sector, is it a monopoly or is it a duopoly or oligopoly? So what sort of a sector you are investing in, you need to do a thorough study of it. The next type of risk is your interest rate risk. Now, interest rate risk is one risk which is very much associated with the fixed income securities like bonds. Now, interest rate risk is the potential for investment losses that can be triggered by a move upward in the prevailing rates for new debt instruments. That means if the rate of interest goes up, the interest rate increases in the market, that has a direct impact on the market price of fixed income securities. Why? So if the interest rate goes up, the market price of the fixed income securities goes down. Why? And it's vice versa. So if the interest rate goes down, the market price for the fixed income securities rises. Because whenever we invest in fixed income securities, maybe a debenture or maybe a bond, suppose there is a debenture which has a face value of rupees 100 and the fixed coupon rate is 12%. that means when you are investing 100 rupees in the debenture, the fixed coupon rate being 12%, you are likely to get 12 rupees after 1 year, because that's the fixed rate of interest. And we all understand that debenture being a debt instrument, you are actually lending the money and you are going to get the interest on it. So a debenture with 100 rupees and a fixed coupon rate of 12% will fetch you 12 rupees after the 1 year. Now, assuming that the interest rates in the market at the time of your investment were 12%, but over the year, say you invested in January, and when you're trying to sell it in December, by that time the interest rates in the economy, due to rising inflation, due to multiple factors, they increase from 12 to 14%. Now you as an investor here are not able to get the sufficient return. That means you know that in the market the interest rates are 14%. So if you stay invested in the debenture, at max you will get 12%. But otherwise in the market the interest rates have risen from 12 to 14%. Now that has a direct impact on the market value of your debenture. So when you go out in the market and you try to sell this, you are not going to get the basic face value. The market price of the debenture goes down because there is an inverse relationship between the interest rates and the market price of the fixed income security. The major reason is that you get a fixed rate of interest on your debenture, you get a fixed rate of interest on the bond, but the interest rates in the economy, they keep on fluctuating. At the moment there is an increase in the interest rate, that has a negative impact on the market price of the debenture. So as a conservative investor, if you decide to put your funds in the bonds or in the debentures or in fixed income securities, you are exposed to interest rate risk. The third category of risk, which is a very popular risk, is market risk. Now, as the name suggests, market risk, a risk which is applicable to the entire market. It is the risk that an investor faces due to the decrease in the market value of the financial product, arising out of factors that affect the entire market, that affect the whole of the market, and is not just limited to a particular economic commodity or a particular asset. When we are saying market risk, as the name suggests, completely applicable to the entire market. Not even a single security, not even a single commodity, not even a single financial asset can be protected against this risk, because it is applicable to every particular commodity, every asset. It is also known as systematic risk. That means a risk which is applicable to the entire system, every single commodity being exposed. Now, this is one risk which is actually driven by the sentiments in the market. That means when I see sentiments, so today if we see the market, suppose there is a bullish run in the market and everybody is buying, everybody is very optimistic, very positive. So the sentiments in the market are very positive. There is a probability that the momentum style of investing will continue and the market will continue to rise. So market risk is something which is driven by the sentiments of the market. That means if there is bearish prediction, if people are becoming negative, irrespective of the fact whether the stock is good or not, whether the business of the company is doing good or not, just because there is pessimism in the market, everybody is negative, everybody is bearish, your stock, the stock in which you have invested, will certainly go down. This is the time when the circuits are even touched. The lower circuit happens and then there is complete freeze in the market. So market risk is completely dependent on the sentiments. It is a risk which cannot be, which you cannot protect yourself against this sort of risk. It cannot be diversified away because you are completely exposed to the market, and anything which happens in the market is applicable on you as well. Now, when there is a lot of movement of FIIs, when the foreign institutional investors, they park their funds in the Indian economy, for example, and suddenly when they pull out these funds, the stock market starts tanking, the stock market goes down. Now here, it really doesn't matter which sector you have invested in. Just because the FIIs are negative, the foreign institutional investors, they are negative about Indian economy and they are taking out the funds, you really cannot protect yourself against it because it is beyond your control. That means if the market falls, at that time you really cannot protect yourself and the probability of risk is pretty high. So we understand that market risk is a type of risk which is applicable to all the investment alternatives, all the options, all the commodities which are present in the market. The next risk is inflation risk. Inflation risk is the risk that the purchasing power of the investment returns will be reduced by increasing inflation. That means if you are investing your product, say for example, you put your funds in a fixed deposit. Now, as we know that these days, if you look at the fixed deposit rate, say for 1 year, is pretty low, say maybe 7% at max. And you know that in the economy, the inflation rate is say 8% right now, or maybe 9%, and if it goes up to 10%, what will happen to your investment? So if you put your funds today in a fixed deposit, which is giving you a return of 7%, and after 1 year, when you check back, when you want to get your fixed deposit matured and take the funds from there, you realize that in the economy, the rate of interest is, or the inflation rate is 9% or 10%. So are you able to buy the same basket of goods and securities or goods and services what you were able to buy 1 year before? No, because now those goods and services have become relatively expensive and the same basket of goods and services cannot be bought with that amount which you invested at the beginning of the year. That means you must identify your stocks, you must identify the investment alternatives, keeping in mind the inflation risk. Because if the inflation in the economy goes up, you will not be even able to cover up the inflation. Forget about the excessive return over and above the inflation. Because your real return gets lowered with the rising inflation rate. Therefore, every investor must check that what is the level of inflation and what is his expected return. So the expected return must always be higher than the expected inflation rate in the economy. Inflation risk actually impacts the investor's portfolio planning, and especially in regards to retirement spending, because whenever we park our funds and we think that we are going to utilize this money when we retire, when you do long-term retirement planning, when you put your funds in pension funds, when you put your money in retirement products, you always expect that this is the amount of money which I will be getting when I turn 60 or when I turn 65, and then you realize that no, these funds are not sufficient enough to buy or they are not helping you out in your daily course, because you will not be able to at least fulfill the basic needs of yours which you calculated say 10 years ago. Because the things have become expensive, because the inflation has gone up, the entire retirement planning actually fails. So the higher the inflation, the less purchasing ability a retiree will have when living on their investments. So even in retirement planning, when people are doing, they must check on the inflation risk associated with it, and they must plan their retirement in a way, the funds in a way that they are able to cover up the rising inflation rate in the economy. Now this is one problem which is specifically associated with again fixed income assets and bonds, because these fixed income assets and bonds, they bear a fixed coupon rate, and this coupon rate is fixed. It cannot be altered with the change in the inflation rate. Therefore, whenever you are investing, we must have a portfolio wherein we have a mix of fixed income assets as well as the stocks. The next type of risk is political risk, which is also known as geopolitical risk. That means a risk which is related to the economy, a risk which is related to the politics. So it is the potential for financial, market or personnel losses that occurs due to a war, terrorism activity, or even for that matter political instability. That means suppose that when the two countries they enter into a war, we have seen this in Iraq case when there was a war, and then the prices of even the Ukraine-Russia war, we've seen the traumatic effects of those wars on the economies across the globe. The oil prices started rising because we know that there's a war which is going on, and then when the oil prices rise, the entire economy gets shaken up. So if there is we've seen in US 9/11 attack, the terrorist attack, the entire economy was went into doom and it was not performing well. Now, irrespective of the fact what sector you've invested, what asset you have put your funds in, if there is a terrorist attack, this is something which you cannot actually do away with. So every investment is exposed to political risk. Now, an economy which declares that there is political instability, if the government of the economy is not performing well and there is a lot of political instability, that again leads to a lot of hue and cry in the economy, and the FIIs do not trust the economy because of the political instability. So again, the stock markets, the financial assets markets will not perform up to the mark. That's again a problem associated with investments, and this is one risk which really cannot be easily done away with. The next is default risk. Now, the word itself suggests default. That means the likelihood that the borrower will fail to repay, will actually default to repay the loan obligations. Now, a borrower has a higher default risk when they have a poor credit rating and limited cash flow. So, if you are a borrower, then if you do not have a good credit standing, then your default risk is pretty higher and you will not be able to fetch more funds. So for consumers, default risk can actually affect the rates as well as the terms which you will qualify for if the lender sees you as a high default risk. Now, it can even be applied to, say, the companies as well, because it doesn't only apply to the borrowers who are looking to take out loans. In fact, the companies that issue bonds or the companies which are issuing debentures, they may also not be able to repay the interest payments and on these bonds. So if the default risk is higher in case of companies, so as an investor we identify which stocks to invest in, which bonds to invest in, or which debentures to invest in, we also look at the credit worthiness of the organization, and when you find that the default risk of this company is pretty higher, then you avoid putting your funds in that company. So as an investor, you have the default risk that the company may not repay, one, the interest, and second, the principal amount of your bond or the principal amount of the debenture at the time of maturity. So as an investor, you must calculate what is the probability of the company not repaying the debt, not repaying the interest payment of your bonds. So that is another type of risk which is associated with investments, especially the investments like debentures as well as bonds or fixed income securities. So another risk is your devaluation or exchange rates risk. Now, devaluation, if a particular economy or a government does the devaluation of its economy, of its currency, through various means, that can be maybe by printing cash and dumping it into the forex market, or by increasing the imports, by levying higher taxes on the exports, or by increasing the supply of currency abroad, or maybe selling the currency to the public for less than its actual worth. And when all these things happen through any of these means, if the government is actually increasing the supply of currency, is actually devaluing its own home currency, then as an investor, you are exposed to exchange rate risk because or devaluation risk, because the value of your money is actually getting depleted over time, it is getting reduced over time, and you will not be able to get the sufficient amount of return. Suppose you want to travel abroad and you want to exchange your funds for foreign exchange. So devaluation of the home currency, that is another risk or exchange rate risk which is associated with investments. So after understanding all these risks, there are two broad categories or two broad heads under which we can segregate all these risks. The first is systematic risk and the second is unsystematic risk. So systematic risk is the risk of a security, which is the sum of systematic risk, and total risk is systematic as well as unsystematic. So unsystematic risk is the extent of variability in the security's return due to the specific risk attached to the particular firm of that particular security. And then unsystematic risk is actually your diversifiable risk. That means this risk can be diversified and hence it can be removed from the total risk of portfolio by investing in large portfolio securities. Why do I say that? Because when you are suppose investing in 5 different stocks, you can actually diversify by selecting such sectors which are negatively correlated. So you understand that if there is one sector which is going down, or if there is a company which is not performing well, or is into a sector which is prone to the variability in the economic situations, you select another stock, say like an FMCG from FMCG sector, fast moving consumer goods, which are not so much prone to risk. So that means you can design a portfolio by having a combination of sectors, by having a combination of companies which are actually negatively correlated, so that you can protect yourself from the loss which may incur by one organization, and you compensate it with the return which you are getting from the stock of the other organization which is not so prone to volatility. That means the unsystematic risk is such risk which can be neutralized, which can be diversified. So as we understood that we discussed about business risk. So when you are selecting stocks from different businesses and those businesses which are negatively correlated, that means you can actually do diversification, and business risk comes under the category of unsystematic risk. Then when we talk about systematic risk is the risk which is applicable to the entire system. All the stocks in the economy, all the we can say all the businesses in the economy, they are exposed. So when we talk about inflation risk, for that matter, inflation risk is systematic risk, because if the inflation rises, that is applicable to all the companies, all the sectors in the economy. When we talk about the say interest rate risk, inflation risk, or when we talk about the political risk, all of these cannot be diversified, non-diversifiable, undiversifiable risk, and that is systematic risk. Whereas unsystematic risk or diversifiable risk like business risk, that is one component which can be done away with, we can neutralize it. So if we understand from the investment perspectives, the total risk is a combination of systematic plus unsystematic risk. Systematic risk cannot be diversified, unsystematic risk can be diversified. I hope you enjoyed this session. Thank you so much and happy learning.